Your balance sheet is one of the most important reports that is generated by your accounting software. But unfortunately, it is also one of the most overlooked. It's not at all uncommon for business owners to kind of freeze once they see a balance sheet because they're not really sure what they're looking at. So today, let's go ahead and walk through not only how to pull a balance sheet in QuickBooks Online, but what we're actually seeing when we look at one. We're going to discuss assets, liabilities, equity, and how they all ultimately fit together on this report. Let's go ahead and get started. So to pull a balance sheet, I'm going to go over here to Reports on the side, and then I'm going to want to select Standard Reports. Now, a balance sheet is going to come up by default in QuickBooks Online in the Favorites section. So you can just go ahead and click on Balance Sheet right here, but if you want a different type of balance sheet, you are welcome to look down here under Business Overview at the different types of balance sheets available. We will be focusing on just a general balance sheet today though. So I'm going to go ahead and click here. Now, one of the first things that you're going to want to do is you're going to want to confirm that you're looking at the balance sheet for the reporting period that you would like to see, okay? Couple things here. When we're looking at account balances, it's important to think about them in the context of how they relate to the documents we receive. If I'm looking at a balance sheet mid-month, I shouldn't expect it to match up with my last month's statement that I got from my bank. So if I want to be doing some double checks, it's really important for me to remember that when it comes to dates. If I have my statements in front of me for the end of April, I'm going to want to only pull this report through the end of April. Similarly, we might want to look at a prior year altogether. So that is the first thing. You can absolutely customize your date here just like you can on your profit and loss. And you can do the same by going ahead and manually entering the date that you want to see here. All right, once you have it set up for the period that you would like to see, the other thing that you're going to want to double check is whether or not you're looking at it on your correct accounting method. And you can change the accounting method quite simply by toggling between these two options. We have cash and we have accrual, okay? Cash basis accounting is all about when the cash actually changes hands. So we only recognize expenses when we actually send the money out into the world, and we only recognize income when we have actually received those funds into our bank account. Accrual is a little bit different. On accrual basis, we recognize both income and expenses when we send the invoices to our clients or when we receive the bills from our vendors, regardless of when we actually see that money change hands. Okay, so one thing you'll notice is if I run this report on cash basis, I don't have accounts receivable or accounts payable. Okay, that won't exist on cash basis accounting. However, on accrual, we will see that we have both accounts receivable and accounts payable. Okay, so again, just keep that in mind as you're running this report. There will be a difference between what you're seeing depending on your accounting basis, okay, or your accounting method, excuse me. So after that, what are we actually looking at on this report? Well, our balance sheet should first and foremost balance, okay? When I'm looking at the total for each section, I want to see the total being identical, okay? So we have here $187,296.84 and $187,296.84. Perfect, okay? Some might ask if it is possible for a balance sheet to be out of balance in an accounting software, and I am here to tell you, unfortunately, yes, it is entirely possible for that to happen. If that does happen, you're definitely going to want to start looking into why that is. Now, I haven't ever seen it happen to people in QuickBooks Online, knock on wood, but I have actually seen this happen in QuickBooks Desktop and in other accounting softwares such as Sage or anything like that. Okay, it can happen. So if your balance sheet is out of balance, stop right there because there is something up with the information. If, however, it is in balance, we can go ahead and start analyzing that however we would like. So the top section of our balance sheet is dedicated to assets, okay? Those are things that our business owns. cash or other tangible assets, and they are listed in order of liquidity. Okay, so that means that any cash accounts that I have, checking accounts, savings accounts, anything like that, those are going to be at the very, very top of my balance sheet. So we can see here, we have bank accounts. The next thing in order of liquidity is actually accounts receivable. And that is quite simply because if I was strapped for cash in my business and needed people to pay me right away, I could go to them and say, hey, how about a 10% discount on your invoice if you pay me right now? And somebody might take me up on that offer, right? So we're again just moving through all of this in order of liquidity. So how quickly can I transform this asset into cash? Cash is at the top because cash is already cash. Then we have accounts receivable. Then we move on to other current assets, okay? Things like inventory, and then undeposited funds is here. Ultimately, hopefully you're not going to see balances in undeposited funds on a regular basis, but that is something that is just sitting there waiting to be deposited into a cash account. So that is very quickly turned into liquid cash. Then we have fixed assets, okay? These things are likely going to take longer to turn into cash if we need to, so they are farther down our asset list. Nonetheless, they are still assets to us, okay? So here we're going to see things like cars, furniture and fixtures, buildings, land if it is owned. All of those things come under fixed assets, and they could be sold and turned into cash if need be. Now, something that we don't actually have on this particular balance sheet, and that's because this is just a sample file, I don't have any tax implications or anything happening here, is under fixed assets, we might actually see an account called depreciation, accumulated depreciation, or accumulated amortization, okay? If we had those accounts, those are accounts that I might expect to see as negative amounts because depreciation is the process of recognizing a large expense over time effectively, okay? So something like a vehicle that has a long useful life of 5 to 7 years, I might not expense that vehicle in full in the year I purchase it. I might expense it over multiple years. Now, this is something that is very much tied to tax law, okay? So what you can and cannot do as far as depreciating assets is tied directly to your tax return. They have rolled out a lot of different provisions in recent years with bonus depreciation and Section 179 depreciation, where you actually can depreciate assets fully in the year you purchase them, given certain criteria are met. Check with your CPA before you assume that you're going to be able to take full depreciation though, because that might not apply. It was starting to be tapered down, and then it actually shot back to 100 in the year 2025, I do believe. So there isn't depreciation on here, but if there was, that would be in this asset section, and it would show up as its own line item and as a negative number. Now, let me just pause right here to say, as a general rule, we don't want to see negative numbers on your balance sheet. There are some exceptions to this. Accumulated depreciation and accumulated amortization are among those exceptions, okay? There's also a few in the equity section, which we're going to talk about in a moment here. But as a general rule, if I see asset accounts or liability accounts with negative balances, that basically tells me that I am missing some information somewhere, and we need to go ahead and address that, okay? And actually, we do have an example of that coming up here, so I'm happy to be able to get to show you that. So that is the asset section of our balance sheet. We have all of the assets that our business owns listed in order of liquidity. So how quickly can I take this asset and turn it into cash? The longer it takes to do that, the farther down the list it's going to be, okay? Now let's go ahead and move into the liabilities and equity section of our balance sheet. Now, liabilities, again, The liabilities are going to be listed in order of how soon they are due, okay? So accounts payable is usually very short-term liabilities. You're usually looking at, if vendors extend terms to you, you might be looking at having to pay that in as little as 15 days, maybe shorter if you're hoping to get a discount. So if you're working with 2% 10 net 30, you might want to be paying that in as little as 10 days. But it can basically go up to whatever terms the vendor has extended to you. So if the vendor says you have 60 days to pay that, great. That is still considered a short-term liability, and that will end up in accounts payable, okay? Basically, accounts payable is anything that you have entered a bill for in QuickBooks. It's going to show up in this bucket until you mark that bill as paid. Then we get into credit cards. Now, like I said, we don't want to see negative balances on our balance sheet as a general rule. So the fact that this business Amex credit card has a negative balance, that tells me that I am missing some information. In this case, I happen to know that I have entered payments from my checking account to this business credit card, and I have not yet entered all of the transactions that those payments were covering, okay? So I know that I'm missing some information, and in order to have a complete and correct balance sheet, I have to go in and enter that transactional data, okay? Once I have done that, I should see this become a positive number, and then we get to move on. Now, occasionally, you might see a credit card actually fall to a negative balance if you accidentally overpay it, or if you pay the full balance due and then subsequently return something, okay? There are exceptions to every rule, and occasionally you might end up seeing your credit card balance in the negative. Basically, if it is in the negative and that is really an accurate representation of the balance owed, that's fine. You just want to be able to speak to it, okay? And in this particular instance, I know that that means that I haven't entered some transactions. But it can also be an indication of duplicated transactions. I might have accidentally double recorded the payments from my checking account to this credit card instead of matching them in my bank transactions tab. So that could lead to negative numbers showing up on here as well. Then we get farther down the list. We get into long-term liabilities. So you'll notice under current liabilities, we have both accounts payable and credit cards, right? Those are things that are going to be due in a short period of time. Then into long-term liabilities, these are things that we're going to owe farther down the road. Generally speaking, long-term liabilities are anything that you have more than a year to pay back. So the car loan, for example, is a 60-month term. The SBA loan, it widely varies, right? Some SBA loans are 5 years, 10 years, but I've seen them go up to 25 or 30 years even. So that could be a really long-term liability that you're looking at there, okay? Now, we are now into the equity section. Now, the equity section really does kind of play by its own rules, okay? First things first, we don't actually want to see any amount sitting in opening balance equity. If you have amounts sitting in opening balance equity, that is something that you're going to want to analyze and look at and ultimately correct. I have seen opening balance equity be used for a variety of things. The thing that QuickBooks uses it for by default is if you connect a new bank feed or if you reestablish a bank feed, whatever the balance is there, QuickBooks might put into opening balance equity. Now, usually that is resolved either by getting rid of that initial deposit amount if it shouldn't actually be there, or by telling QuickBooks where that money actually came from. So sometimes you close one checking account and open a new one and you just do a balance transfer. So you record the transfer and then that zeroes out that opening balance equity amount. Other times, however, this is used as a default when you're setting up inventory or something like that, and it can actually really cause issues in your reporting. So if you're seeing balances hanging out here, especially over years, you're going to want to address why they're there and make sure that they get moved to the correct account or that you fix whatever is going here by default. Okay, the goal for opening balance equity, always zero, because the money has to have come from somewhere, even if it is just the initial deposit that you as the business owner made when you were opening your business checking account. you provided that $50 or $100 or $1,000. So that should actually be classified as an owner contribution, not as opening balance equity. Okay. Now we have owner investment. This whole equity section, like I said, it plays by its own rules. So this is a section where on the balance sheet, I might not be surprised to see negative numbers. Okay. Basically, the owner investment account is positive if you as the business owner have currently contributed more to the business than you have taken out in withdrawals or shareholder distributions. Okay. So currently we do have an owner investment amount of $2,000, and that is a positive number. But if the business owner started to take money out and classify it as owner distributions instead of wages or anything like that, we would see this owner investment account dip into the negative and possibly just keep going right into the negative. And that would not be troubling. Okay. That would be a possibly correct thing that we could see. Now we have retained earnings and net income. Okay. Now net income, very simply, is the bottom line on your profit and loss. Okay. Whatever your current income is in your business for the time period that this report is being run, that's what's going to show up in net income on the balance sheet. Retained earnings is a little bit different. Retained earnings is basically a running total of all of the money that your business has made over time, okay? So if you took a loss for the first 3 years, your retained earnings would be negative until you made a profit, and then that would get added to whatever that negative balance was, and it would slowly start to move into the positive as you continued to have profitable years. I will be doing a separate video explaining retained earnings because it really does warrant its own discussion. But that is, again, another one that I wouldn't necessarily be troubled to see in the negative, except that it would just mean the business wasn't profitable yet. Same with net income. Net income can absolutely be a negative number. We might have spent more running our business than we made. That's totally fine. Ultimately, we of course want to see all of those numbers being positive, but it wouldn't mean that anything was wrong with our reports or with how we had classified transactions if these particular accounts were to be in the negative. So that is our balance sheet. That is what we are looking at, and that is what we should be seeing when we log in. At the very top here, we have all of our assets, all of our cash accounts, all of those things. Then we have all of our liabilities. And then finally, we have this bottom equity section. Okay. Those are the 3 primary categories that we're seeing and looking at, and they all interact together. Okay. All of these accounts are part of the dual entry accounting process. It's how we end up seeing our reports being complete and accurate. I really hope you found this video helpful. If you have any questions, please feel free to leave those in the comments below. I'm Holly from Accrual Mistress Bookkeeping and Consulting, and please consider subscribing if you'd like to see more videos like this one.